Can I buy a business with my self-directed IRA? Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. So we've all heard about Peter Thiel and other super successful investors that were able to invest in startups with their IRA, or better yet, Roth IRA, and generate tax-free gains on those returns. Wouldn't it be great if you could put 50 grand into a business, work in it, and then sell it tax-free in a Roth? Well, not so easy. Couple rules we need to consider. And the first and broadest is found under Internal Revenue Code section 4975. And 4975 deals with the prohibited transaction rules. And it says this as follows. You cannot do anything with your IRA that in any way directly or indirectly personally benefits you, a lineal descendant, parent, child, spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. So if your IRA is going to invest in a business that you're going to have 50, 60, 70% control of, and you're going to work in that business, you're going to violate 4975, and that transaction will be deemed prohibited. Now, what happens if you own 15 or 20%? Could your IRA invest? Well, facts and circumstances. You'd want to show, and you'd need to show if audited, that your IRA investment did not directly or indirectly personally benefit you. So here's an example. And this is a case called Rollins v. Commissioner. It's a tax court case from about 15 years ago. In this case, Rollins was an accountant. He owned a bunch of businesses, all under 50%. So you would think that'd be kosher under 4975. The businesses needed money. He took his 401k, lent money to the businesses, prevailing interest rates. Good investment. The money went back to the 401k. Everything was good. IRS audits the transaction somehow, and they argue prohibited transaction. Rollins says, what do you mean? I own less than 50%. It's good under 4975. And tax court says no. You need to be able to show that 100% of the benefit of your IRA investment was derived by the IRA. In this case, the businesses needed money, and hence, since he owned the businesses personally, that investment didn't just exclusively benefit his IRA, it also benefited him, which was deemed prohibited. So if you have a business and you're running it, over 50%, you can't do. Under 50%, you got to think about Rollins. You got to think about personal benefit. Can you prove that you're not receiving any benefit from that investment? Obviously, the bigger the business, easier it is to argue. Smaller the business, harder. The larger the amount of money invested, more difficult, right? If you're having a startup like Peter Thiel, PayPal, there's going to be hundreds of investors. You're putting in a very small amount of money. You're going to own 0.5% of the business. Maybe easier to show that your IRA is not exclusively, or you're not exclusively benefiting, your IRA is not generating or triggering a prohibited transaction. Fair. But if that investment was $400,000 and the IRA was going to own 32% and the company needed the money, tough. So you see where I'm going. It's tough. Anytime your IRA invests in a transaction like a business and you have some personal involvement, especially if you're taking a salary as an executive, you got to be cautious. Even if you're under 50%, be cautious. Now, 1, 2, 3, 4, 5% of a larger business, probably okay. One last thing to mention, UBIT, unrelated business income tax. If your IRA invests in a business and it's a pass-through entity like an LLC, you could, if the IRA is allocated income, net income of over $1,000 on a K1, that could be subject to UBIT, which can go up to 37%. So number one, you have to worry about prohibited transaction rules. Make sure your IRA can actually make the investment without triggering 4975. Definitely under 50%. Even if it's under 50%, got to be careful. Let's say you get through that threshold and you're comfortable with the investment. Number two, you got to worry about UBIT. If the business is a pass-through entity, it may not even make sense because the UBIT tax can go as high as 37%. So even if you feel like you can do it under 4975, the UBIT tax may just make the deal very unattractive from a tax standpoint. So you got to be careful. If it's a C Corp you're investing in, then the C Corp will block the application of UBIT and you'll be kosher. You'll be good. S Corps. IRAs cannot invest in S Corps. That's not an IRA rule. It's It's an S Corp rule. The S election gets blown up if an IRA invests in an S Corp, turning the S Corp into a C Corp. So just be cautious about that. In general, you can invest in IRA in a business. Obviously, if you're not involved or any disqualified person, no problem. You can buy Tesla, Apple, or any other third party business. If you're involved, make sure you're under 50%. The lower the ownership level, the better. If you do it, you got to now worry about UBIT. If it's a pass-through business, over $1,000 in net income, consider UBIT. If it's a C Corp, you're good to go. You don't have to worry about UBIT. Remember all that. It's complicated. That's why it's important to work with a company like IRA Financial that can help you navigate these rules.